battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. For the past 44 years, it's been our family's mission at Stenger Family Office to deliver you clarity and confidence to help secure your financial future. Thank you for coming back each and every week to the show, and I will just remind you of some of the big events coming up. We've got episode 200 of the podcast very, very soon. We want to say thank you to all of our longtime listeners. We started this thing in the middle of COVID in 2020 and just never stopped. Thought we'd run out of content, but turns out we didn't, so we're still here. Thank you for coming back each and every week. We so appreciate it, and don't miss this thing. We literally have like 4 spots left. It filled up really, really quickly here in the last week or so, and you're more than welcome to come. If you can get a spot, call Katie immediately, Katie the Greek, or right there on YouTube in the description, click on the register button, and we'll get you in. We may have some standing room only at the end here. We'll let you know, but make sure you come to episode 200, and after that, you got to come to 2026 Investor Day, which is, in fact, in 2025. We always like to be forward-looking. This is October 16th and 17th in Oak Brook at Gibson's, the best restaurant in the suburbs, in my opinion, one of the best. And the night before, we're at Maggiano's, but we got a stacked deck for you. This thing's almost full, too, at 100 and some people now signed up, and we've got capacity for 130. So if you're thinking about coming out to this, we've got about 14, 15 couples left that can sign up. So make sure you register immediately, also in the description there on YouTube. Now, let's jump into this week's episode. This is episode 197. This is Even When It's Your Own Blood. What am I talking about? I'm talking about the famous quote that you should be buying stocks. The time to buy is when there's blood in the streets, even if it's your own blood. Now, on financial entertainment, on Twitter, all the experts like to come out of the woodwork and tell you this quote all the time. And then when a stock goes down 50%, they immediately panic and sell. And it's easier said than done to buy when there's blood in the streets, but most people don't do it because it's really, really, really scary. Now, I'm not going to give you stock advice here, so don't do anything I'm about to tell you. Don't take this as individual investment advice. There's my disclaimer. I'm just giving you examples. This is for entertainment purposes only. And let's talk about United Healthcare. United Healthcare, since the peak, happened pretty quickly, is down about 58 to 60%. Everybody's panicking. Everybody's worried. Now, this is, of course, a stock we had in the Stenger Family Office portfolio. We have had for many, many years, and it did really well. Before this most recent correction, you were a happy camper with your United Healthcare stock. You were up 86%, not even including the dividend. And now the stock is on sale. I'm not telling you to buy it. I'm not telling you what to do with the stock. It's not investment advice. But the stock is now down 58% from its all-time high. And now you want nothing to do with it. So this is when people in the investment industry make their money. They make their money when nobody else wants to buy these stocks, when they're untouchable, they're unloved, they're hated, the narrative is awful, the world's coming to an end. And I can't tell you how many stories have been like this in the past for a variety of companies, no matter how good they are. Now, I'm not saying any of these stories I'm about to tell you are exactly the same situation as United Healthcare. They're all a little bit different, and that's the point, because the media's job in each one of these cases is to get clicks on stories, so they put out a ton of clickbait and try and get you to panic. And one of the things they're going to do that is say, this time is different. This is different than all the rest because here are the facts and circumstances, when in reality, every single one of the cases that we're about to go through here have all had different facts and circumstances. So one in particular, I remember this like it was yesterday, was Meta. Meta was trading, this is the old Facebook, Meta was trading for $378 a share in September of 2021. It went down 70% from September of 2021 to November of 2022. It went down at 1.76% to $90 a share. Okay, think about this is worse than the United Healthcare story. Literally down 76%. United Healthcare is down 58%. An absolute bloodbath. You want to talk about blood in the streets? That was it. Now, we had originally bought Meta for most of our clients right around 150, and we thought we were doing really well because at one point it was in the 370s. We were buying it at 150. We're like, hey, this is pretty good, right? We bought it on sale. Then it goes to 90, and people are like, Nick, you're a moron. What were you thinking? You bought a stock at 150, and now it's 90. Okay, I said, hang on a second. Let's look at the fundamentals here. And it turned out that Meta was trading for 12 times forward earnings. They put it in the value category of the S&P. It used to be this high-flying growth stock. And then they put it as a value stock. They basically said this thing is dirt cheap. And we looked at the earnings. We looked at the earnings growth. They've got like half the world signed up on their platform, which there's not too many businesses on earth where you have half the world as your customers. And we said, we got to buy this thing. And so we bought it again at 96, 95. Some of our clients we got in at 90, depending on when they started with us. That stock today is trading at $760 a share. Okay? So before you send me a text, an email, a tweet, whatever you're going to send me an email, whatever, call me, Nick, what in the world were you thinking? I'm not saying United Healthcare is exactly the same. I don't know what the future holds. Yes, we got the crystal ball here. Can't tell you exactly what's going to happen. We're very humble and aware of the fact that we always could be wrong. But before you panic and get all bent out of shape, just remember stocks are volatile. And the best stocks go down 50, 60% sometimes. So let's go through a list of recent corrections. Today, Arista Networks, which is a stock we talked about on Bullish about a year and a half ago, at one point was down 46% from peak to trough. If you go back to January 24th of 2025, that stock traded for $129 a share. Then it went down on April 4th, 50% to $64 a share. It literally got cut massively, and you didn't panic. Nobody sent me a text. Nobody sent me a, hey, is the world coming to an end? And what did you do? You bought more. On April 4th, you bought it at $64. Today, they just came out with earnings. The stock is up 16% just today. This is why you can't time the market. And it's up 114% from the bottom when you might have wanted to sell it. This is what I keep trying to hammer home on the show. And you're saying, Nick, why do you keep coming back each and every week trying to tell us the same stuff? I had somebody say, Nick, you just say the same thing on the show every week. Okay, I will keep saying the same thing on the show every week until the texts and emails and all the people saying, oh, the world's coming to an end. And that's never going to happen. So we are going to have plenty of ammunition for years to keep coming back here and telling you the same message of stay on your plan. Because this is when the going gets tough, when it gets hard to hold stocks, when it gets hard to buy into the fundamental story of the company, and it's easy to buy into the narrative the media is telling you that bullish investors, over time, patient investors make most of their money. You make most of your money in a bear market. You just don't know it at the time. That's what Shelby Davis said, one of the most famous and successful mutual fund managers of all time. Peter Lynch said it. Another famous mutual fund manager had one of the best track records of any mutual funds ever on Wall Street. And Peter Lynch said that you buy a stock for $12, it goes to $6, you have a meltdown, you panic, when in reality you should be buying it again at $6 if it's a great company. And that's exactly what I think has gone on with all these different companies. Now, here's Amazon. We all know Amazon. This is an easy story to tell because most of us have a package on our door almost every other day. Amazon in November of 2021 was trading for $183. By January of 2023, it was down 53%. You go, no, that didn't happen. There's no way. I'm not making this up. This is live data. You can pull this up for yourself. Went down 50%. Amazon now is back to a record all-time high almost. It went to $235, $236 a share. It's right off that all-time high today at $215. Did you sell it? Did you panic? I hope not. In 08 and 09, Amazon went down 52%. In the late 90s, with the tech bubble, Amazon went down 86%, 86, 87% in the 90s. Think about that. So all the people who held their Amazon stock through the 90s, today, let me give you the number, are up about 143,000%. That's a real number. How many people actually stayed on their plan? How many people didn't panic? Not that many. NVIDIA, our favorite one to talk about right now. NVIDIA in November of 2014, not all that long ago, was trading at $147 a share. It went down 36% in just a few months, down to 94. It recovered all of its losses and is now up 89%, back to $178 a share. In November of 2021, NVIDIA went down from $31 a share, 64% drawdown, to $12. Yes, you could have bought NVIDIA for $12 3 years ago. So don't forget stocks are volatile. Apple. Apple's up 3.5% today. Everybody said the world was coming to an end for Apple. Apple is up 89% the past 5 years after going through a 23% decline, a 12% decline, and most recently an 18% decline. And if you go back further on Apple now, Apple was down at one point. This was just 2018, not all that long ago. Apple was down 32%. What did you do with your Apple stock back then? A couple more examples. ExxonMobil traded for $100 a share in May of 2014. It went to 66. It went down 66% to $30 a share, $34 a share. The narrative at the time was ExxonMobil was going to go bankrupt. Okay, that was the narrative. We're not talking about that with United Healthcare today. The narrative with ExxonMobil was they were going bankrupt. Okay, ExxonMobil is back to $108 a share. You cannot trade this. You cannot time it. You cannot figure when to get in and when to get out and all this stuff. You just can't do it. Tesla, the one that everybody loves to hate right now. Tesla, in October of 2021, went down 70%. But the past 5 years, it's up 227%. How do you make money in the stock market? Behavior. And that's the reality of being on a plan. You have got to just make sure you've got your behavior in check. You know what you own. You know what you've got. And you're not going to get off your plan. I'm not saying United Healthcare is going to have this massive run. I'm not saying it's going to go way back up to the record all-time high overnight. I'm not saying anything like that. But all that to say, just think twice before you panic. Stocks are volatile. So in the short run, stocks are more risky than bonds. Bonds maybe go down 2, 3, 4%, depending on what kind of bond you have in the short run. But in the long run, the true culprit of a retirement plan is not stock market volatility. It's inflation. It's the chance you run out of money because of the rising cost of goods and services over a 30, 40-year time horizon. And you say, hey, there's no way I'm going to run out of money. I got 2, 3, 4, 5 million bucks. Some of our clients have more than that. Okay. Well, I've got a client right now, mom and dad in a nursing home, $6-7 million portfolio, thought they were good, costing 30 to 40 grand per month in long-term care around the clock expenses. You know how fast $6 million goes when you're spending 400 grand a year on care? It's incredible. And so if you've got a $2-3 million portfolio, you better be careful before you jump into that safe, so-called safe portfolio. It may look safer in the short run, but in the long run, you could be in the most risky portfolio of your life if you're not in equities. Now, what we've told you is have money for a rainy day, have cash. Cash is king. Have money in treasuries, T-bills. You get paid for that holding those right now, 4.5%, depending on what you got. Everything else, U.S. equities. U.S. equities are the finest place to be. I can't tell you the kind of technology innovation we're seeing. We're just on the absolute cutting edge of, I think, what's coming. And what's happened with AI now is machine learning, which has been around for a long time, the cloud, high-speed computing, it's all starting to become mainstream. You started to see this slow wave over time, use cases that have worked at Fortune 500 companies. Well, now it's all going mainstream. So ChatGPT essentially brought AI to the forefront, and it's showing you exactly what machine learning can do, what blockchain can do. You see this with crypto now. Blockchain's been used for a decade. But now with crypto, you're seeing what it actually can do. Full disclosure, I don't own any crypto, but it's fascinating to watch. And all this to say, yes, there's pockets and there's pieces of AI that ultimately will be a bubble. I actually think there's pieces of AI today that are more overvalued than the tech bubble was in 1999. You saw companies like Pets.com trade for a few hundred times earnings. You're seeing companies today get 50, 60, $100 billion multiple valuations with no earnings at all. And so that's even worse. But there are real pieces of it. And one of the real pieces is the cloud. I've talked about just the cloud migration. You used to have this thing called on-premise data centers. You had all these companies with on-premise hardware and software and all the rest of it. And you'd have to download software to get your program to run. Everything's moving to the cloud now. A lot of companies behind this. There's literal companies. There's actual companies out there with 300-400 consultants that do tons of revenue where all they do is they help Fortune 500 companies migrate to the cloud. That's a massive, growing, booming business. Same thing with CrowdStrike here with cybersecurity. Cybersecurity is one of the last things that a company is going to cut from its budget. And there's not a whole lot of worlds where you'd see a corporation say, oh yeah, no, let's reduce our cyber infrastructure. Let's reduce our cybersecurity footprint. They're not going to do it. It's a huge risk. So all the industries that you could never imagine, you could never have dreamed of 10 years ago, you never could have dreamed of 20 years ago, are here now, and they have incredible amounts of jobs. They created all this wealth, and they're doing things that you never thought were possible. And so just like a centrally planned economy where you have 3 or 4 people at the top or 20 people at the top trying to figure out, let's put this piece there and that piece there and try and centrally plan the economy, the reason that doesn't work is because nobody knows what the future holds. And I continue to tell you this on the show, that even in your best and wildest imagination, you have no idea what the next 5 years holds. You have no idea what the next 10 years holds. And because of that, you should be an optimist. You should be a bullish investor because the future, in my opinion, is going to be bigger than the past. There's technology coming that you just have no idea. You have no idea what's coming. And I even look at Zoom, again, not telling you to buy or sell the stock, but look at Zoom, the conferencing system. I can do a meeting now, and I turn on AI Companion, and within 3 minutes after the meeting, I have an entire summary of what we talked about. This is incredible. We didn't have this a year ago. We didn't have this 3 years ago. We didn't have this 5 years ago. Think about what this is going to do for productivity. Think about what this is going to do for profit growth across the Fortune 500 against the S&P 500. And that's why I say be an optimist over time. So all the doom and gloom narrative this year that said, hey, earnings are going to fall apart, tariffs are going to destroy the economy, we're going to have these massive drop-offs in profits, they got it completely wrong. And all the estimates, we covered this on Bullish, Sam Hardy talked about this on our latest Bullish episode, all the earnings estimates now coming out are better than anyone could have imagined. We're targeting now $340 in profit on the S&P in 2027, which is where the market eventually is going to trade. And if you multiply that by 20 to 22 times earnings, I believe the S&P fair value minimum is 6,800. I think eventually you're going to see 7, and then you're going to see 7,500 after that. Now, I don't know enough to tell you exactly when it's going to happen. I can't tell you if it's going to be next month, a year, 18 months. But the general trajectory of the market is we are headed to 7,000 points. And then after that, we're headed to 8,000. And after that, we're headed to 9. So if you are on a plan, if you've got enough to cover you for the bad times and you have enough in equities, you just participate in the market ups and downs. And once in a while, you're going to see these stocks go down 50%. You're going to see them go down 70%. You're going to see maybe even an 86% drawdown. And it's your job to determine, am I going to panic or am I going to stay on my plan? So part of what we get paid to do, one of the huge things we get paid to do, is remind you this too shall pass. The world is not coming to an end. And out of a portfolio of 50 to 60 companies, you're going to have maybe 1% in a stock that goes down 50%. You're going to have 2 or 3% in a stock that goes up 50%. So at the same time, the math of the portfolio is such that over the long run, these returns will balance out. And if you look at S&P 500 returns now, Dr. Siegel studied this for 200 years. Dr. Siegel says long-run return on equities is 10% per year. If you know that and you have that backing within your portfolio, you say, why should I ever worry? Why should I sell my stocks when they're down 50%? If I've got enough of a goals-based plan, if I'm prepared for these things ahead of time, I'm not going to sell, no matter how tough things get. Now, I do think we're going to eventually see about a 5% pullback. We haven't had a 5% pullback in a little bit. We're due for a 5% correction. And that's a buying opportunity. I think today's a buying opportunity, depending on your long-term horizon. If your horizon is 2 years, 3 years, 4 years, 5 years, certainly if you're 40 years old and you got a 20-year horizon before you hit 60 and retire, you should be in equities. I mean, what else would you want to be in? Equities are the place to beat inflation. Equities have the staying power to raise their prices. Not every single equity is going to do well. Not every single company and every single sector is going to do phenomenal. But if you're diversified, more of the stocks are going to go up than go down. And if you're already in a market cap weighted portfolio, meaning that you're buying the biggest and best, the better a company does is it's going to rise through the ranks of the S&P. It's going to go from a top 100 company to a top 75 company to a top 50 to a top 10. And that's exactly what's happened with NVIDIA the past 5, 6, 7 years now. It's gone from almost nothing in the S&P to a top 2, 3 stock. And that's how the meritocracy of the stock market works. So stay bullish, stay on your plan, do not panic. Yes, I tell you the same thing each and every week, but it's a reminder so that when the bad times come, not if they come, but when the bad times come, you don't panic and you don't sell. Come to the live taping of episode 200 here on August 26th. Don't miss it. And then we'll see you again in October for Investor Day. Thanks so much for being on. We'll see you next week for episode 198.